This video we will talk about the daily chart on NQ and how it's been manipulated, how we expect it to keep trading, and the overall direction that I expect it to go in now. So since November, we've been held in this range bound condition. This is the absolute largest range bound condition we've ever seen in NQ or in any index fund in history. Like, pretty much unprecedented. ICT's never seen it, I've never seen it, no one's seen this. It's clearly manual intervention, they're clearly holding it, and since Trump's come into office, it's honestly no one's enjoyed this marketplace. It's been terrible. He's talking every couple of days. There's always manual intervention. Him and his son are always doing this next level insider trading. We'll put your tinfoil hats on. I mean, I don't think there's any argument against that from what we've seen in the like crude oil, what we've seen in the metals. There's clearly manual intervention, and then on top of that, we have black swan conditions, which is when we have the high potential for a very large gap in the market or incredibly fast and incredibly rapid, incredibly large movement in a matter of seconds, like we saw a couple of weeks back, or even like 1 week ago, when Trump did a tweet that he would not bomb Iran for 5 days, and then the market goes like 700 handles up in just like a minute. So we have these crazy conditions where it can do whatever it wants pretty much. It doesn't need to obey general algorithmic principles. It can at any moment gap several hundred handles, maybe even 1,000 handles in either direction. A bomb can go off somewhere. There's crazy stuff going on. So before I talk about the daily chart, consider subscribing if you like this content. It's free and you can always change your mind. So what we're looking at here is balanced price range. This entire from November forward is range bound, but the balanced price range in my eyes, in what is the most obvious, most recent one, would be this here. And this makes sense on a weekly and a daily chart. I'll show you the weekly in a moment. But here, we're constantly redelivering the sell side and the buy side. So we're basically offering price both ways many times. So that can sound like, well, that's a consolidation. Balanced price range can be a consolidation. It isn't always. In this case, it is, but it's a prolonged one where it's constantly taking out the highs and lows. A consolidation, you want to see nice, tight, packed area like this, where it's easy to trade through that because it's relatively close. But here, this is a balanced price range, so it's slightly different. You can see this as a consolidation as well, but it wouldn't be a consolidation that acts as a draw on liquidity, in my opinion. That's just my opinion. Then up on the weekly chart, you can see that it's these overlapping wicks, and then on the following weeks, constantly redelivering the same buy side and sell side delivery. You can make the argument that the balanced price range is using these levels because these are the ones that are most revisited. That's fine if you want to think that. I would disagree because you've seen me do this in live streams and in previous videos where if we have overlapping wicks like this, these are the ones that are balanced price ranges. And in certain narratives, not in every context, but in this context, I would argue that this is a balanced price range. Balanced price ranges are the most objective, in my opinion, concept of ICT because everything can be a balanced price range if you zoom in enough. However, when coupled with narrative and a little bit of experience, not intuition, experience, you can get some highly accurate areas where price should not find easy to trade in. So on the weekly chart, we've got these two relative equal lows. It traded down into them, and you're seeing here an annotation of what a sweep is versus a run. If you're bearish and you have relative equal lows, you want to see it run through them, not sweep them. In this case, it swept them. So it's going against what we generally want to see. However, the narrative, in my eyes, is strong enough that it should end up creating a bearish order block and trade lower anyways. A run is when we close through the low. A sweep is when we trade below it and then trade back above it. Here it's traded below and it's traded back above. It's gone to balanced price range again. I don't think that it's going to have an easy time trading up in here. I think it'll be high resistance and it'll turn. Maybe we'll see some candle compression on the daily chart where it trades in here for 1-2 days and then it starts turning and then draws toward this relatively low. Doesn't mean that it's going to happen this week. This is not a weekly outlook where I just say it's going to happen this week. This is an overall draw and an overall macro perspective for what's going to happen on the weekly, the daily chart. From these relatively lows, once it takes that, it's got this SIBI, it's got this swing low, it's got a bunch of other levels that we'll go through if indeed it does take these relatively lows. So back to the daily chart, the relatively lows I just showed you on the weekly. You can see here that it's left an inversion fair value gap. So this was a bearish fair value gap, but because it's traded above and closed above, That's an inversion fair value gap, like so. Price trades down into it, leaves a wick in the upper quadrant, body closes all the way up here. That would typically be a heavily bullish sign because it's respecting the upper quadrant of an inversion fair value gap. It's bullish order flow. But because we've traded up into this area of balanced price range, this should be high resistance. It should not find it low resistance and easy to trade through. It should not be making clean price runs like this. What it should be doing is the opposite. So anytime it trades up into this, I want to see it essentially have a very hard time where it's dragging its feet, it's making a fuss about it, it's not going there easily, it's constantly negating bullish sentiment, and eventually turns and goes lower. Not necessarily one candle like this, but eventually you get the picture. It should start turning and going lower, in my opinion. Again, this is just an opinion that I'm sharing with you. So where we're trading currently, we have this SIBI and we have this order block. It doesn't really matter whichever one you use. Everyone's going to naturally gravitate to their own type of PD array. I like fair value gaps. I like grey pools. I like breakers. I like repulsion blocks. I like a lot of weird stuff. This is fair value gap. I would typically opt for the order block here. However, because it's formed off of a new week opening gap, I don't have a lot of experience using an order block that is formed off a new week opening gap. So I'm going to look at the bearish fair value gap, and I'm going to place a lot of emphasis on this. I'm not saying it has to respect this. It is absolutely allowed to trade into the bounce price range. It's absolutely allowed to do that. It can go as far as the consequent encroachment. However, I would prefer that it doesn't breach this high here. If it does breach this high here, I would want the body to stay below consequent encroachment of this candlestick, which is this black line. Consequent encroachment is just a fancy term for the middle. So if it trades above this liquidity here, this blue line, then as long as the body closes below this black line, which is the consequent encroachment of this candlestick's premium wick, which means as long as it's not closing past this line here, I can maintain my bearishness. So I can stick with the idea that it should be bearish. However, if it closes through that level, unless it shows some exceptional bearishness to this volume bounce, like it closes through here, and then the next candle goes into that and immediately rejects, unless that happens, I wouldn't place any emphasis on being bearish again. I would have to flip my bias, and I'd say, okay, probably wrong, gonna go long. That rhymes. So overall, I want to see us trade into the relatively equal lows. Now I'll talk more about the manipulation we've seen on the daily chart. So, like I said at the beginning of this video, this has been the longest prolonged consolidation we've ever seen, ever. It's horrible. No one's enjoyed trading in this condition, and the latest has been the worst, because at least here we had some kind of movement where it was a couple bullish days, a couple bearish days, a couple bullish days. Here it's been just flip a coin every day. That's what the market makers have been doing. Let's go bullish today, let's go bearish today. They've just been holding it, and you know, because of what we've seen recently with the war, unfortunately, that's the wicked way of the world, and it's invited this volatility into the marketplace. Cool, it is what it is. There's nothing we can do about that. However, because we've seen a lot of movement on the dollar, on crude oil, on these assets that are heavily influenced by the war, like metals, the money flow is increasing now, meaning that money's going out of certain assets, it's going into other assets. It's probably not going into the Nasdaq. No one's taking their money out of gold to put it in the Nasdaq right now. However, because the dollar is having a lot of money flow, meaning people are taking money out, putting it into the dollar, petrodollar is still a thing currently, maybe not for long, but currently is. We could see more volatility, just like we've seen since 26th of March. So I believe with the current events that have unfolded on the daily chart, where we've seen it trade up into this balance price range, this is a Judas swing, where it's going to trick retail traders in. Obviously, I can't say obviously, but because it's the middle of a war, and everyone would assume that it's going to be bullish or bearish, everyone's going to have an opinion. It's just going to be the fast movements that are tricking people in. So anytime it moves fast in one direction, they're going to start chasing it, thinking that, okay, this is the breakout that is because of the war. So it's going lower now because it wants to permanently go lower for the rest of time because we're in a war. It's not like that. Wars come and go, and that's just how it is. It's going up now quite rapidly. I'm overall bearish, meaning I expect it to go into these lows. So everything that's happening here is happening in my eyes, in my mind, for the sole purpose of engineering a way to go into these relatively cool lows. So this here, these three up close candles, are nothing more than a fake move, in my opinion. It shouldn't breach the consequent encroachment of this bounce price range. And so I have given it a lot of room where it can do whatever it wants up here. It can stay here for as long as it wants. But once we see something like, say, a change in state of delivery to sell side, or a market structure shift to this low, or an inversion fair value gap on, say, the 4 hour, that's when we can start to look for these relatively close to be delivered. How fast will these be delivered once a reversal signature like a change in state of delivery or a market structure shift occurs? I don't know. I can't give you that prediction. I don't know how long it's going to stay in this bounce price range. What I do expect is that it's not going to breach this bounce price range, and it will eventually trade into these relatively good lows, and maybe even further. I'm not going to make the prediction that it's going to go to these lows. I don't know, but these look real nice. I think everyone's been looking at these lows in the ICT space, but recently what I've seen online is everyone's immediately switched their opinion the second they saw an inversion fair value gap. Look, I love inversion fair value gaps as much as the next guy, but you have to couple it with a narrative. And in my opinion, again, my opinion, it's gonna end up failing and it'll trade lower, disrespect the bounce price range and go into the low. So that's it for this video. Thank you for watching. Hopefully it's been educational and interesting. If you enjoyed the video, leave a like and subscribe. It's free, it costs you nothing, and you can always change your mind. See you in the next one.